Welcome to RAD Accounting Tutorials. So today we're going to talk about books of prime entry, which is also known as books of original entry or subsidiary books or journals or the books. They are all the same. That is what we are going to talk about today. Before we continue, subscribe to RAD Accounting Tutorials and click on the notification bell so you get notified anytime a new video is uploaded. Okay, so when we talk about books of prime entry or books of original entry, what do we mean? A book of prime entry is a book in which transactions are first recorded before being posted to the ledger account. So if a transaction occurs, the book that is recorded first before it is transferred to the ledger account is what we call the books of prime entry. It is recorded before it is posted. When a transaction occurs, it is recorded in the books of prime entry before it is posted to the ledger account. So generally, journals are used to record daily transactions on credit. Daily transactions on credit. That is what we use the journal for. That is what we use the journal for. So simply put, they are books of original entry in which accounting data is entered before it is entered into the ledger account. That is the meaning of journals or books of prime entry or books of original entry or day books. Okay. So what are some of the functions of the books of prime entry? One, it is used to ensure the completeness of all information posted to the ledger account. If we want to ensure there is completeness in the information that we've posted into the account, we check it from the journals. Was it the journal that is recorded first before it is posted to the ledger? Two, it makes reference to original document very easy. And it makes reference to original documents very easy. Three, it reduces the volume of entries made in the ledger accounts. Yes, since only periodic totals need to be assumed, all the transactions that, let's say, when there is a purchase on credit, recorded in the purchases journal, that is when a purchases journal, then the total. So recording one, two, purchasing the purchases journal. Then we transfer entries made in the ledger account. These are few functions of the books of prime entry. You can journals, which is the same as the books of prime entry. There are two main types of journals. There are two main types of journals. One is the special journals, and two is the general journals. Is the general journal. So first of all, let's talk about the special journals. When we talk about the special journals, we have the purchases journal, which is also known as the purchases daybook. We have the sales journal, which is also known as the sales daybook. We have the sales returns journal, which is also known as the return invoice daybook. You have the purchases return journal, which is also known as the return outwards daybook. We have the cash book and we have the petty cash book. So these six are the special journals that we have. And then that is all for the special journal. And the general journal is on its own. That is all. That is the seven journals we have. Six is the special journal, and the last one is the general journal. Okay, let's take it one after the other. The purchases journal or the purchases daybook. The purchases daybook is used to record daily credit purchases of a business using a copy of purchases invoice received. So when we make a purchase on credit, when we make a purchase on credit and we receive the purchases invoice, it is the purchase invoice that we are going to reference to make a recording. And the recording is going to be done in the purchases journal because the purchase was made on credit. So any purchases that a business makes and it is on credit, we first record it in the purchases journal or the purchases daybook. That is what we use the purchases journal for. The sales journal. The sales journal is used to record daily credits sales of a business using a copy of sales invoice issued. So when we make sales on credits and writing an invoice to the customer, is the sales invoice that is going to be our source document for recording our sales on credit. And this recording is going to be done in the sales journal or the sales day because the sales was made on credit. That is all. Then we come to the sales returns journal, which is also known as the return inwards daily. What this journal is used for is used for recording transactions involving goods returned by customers using a copy of credit note issued or a copy of debit note received. So when we make sales to a customer, and now the customer is returning the goods due to some reasons. Let's say some of the goods are faulty or damaged. Therefore, the customer is returning the goods. This amount of goods is going to be recorded in the sales returns journal. It's going to be recorded in the sales return journal using a copy of credit notes issued. So when there is goods returned to the business is going to issue a credit note to the, the customer, showing that we are owing the customer. Since they've returned the goods, it means we are now owing the customer. That's why we are issuing a credit note. Or if the customer is returning the goods, he will come along with a debit note showing that we are owing him. So it's either the customer comes with a debit note or we issue a credit note when there is sales returns. So the sales returns used to record goods returned by a customer. We have the returns journal or the return outwards day. It is used to record transactions involving goods returned to suppliers using a copy of credit notes received or copy of debit notes issued. So this time it is the business that has purchased goods from suppliers. And after receiving the goods, we find one or two reasons we want to return the goods back to the supplier. So when we are returning the goods back to the supplier, it will be recorded in the return outwards table. That is all very simple. And this will be done using a copy of a credit, sorry, a copy of the debit note issue. So if we are sending the goods to the supplier, we are going to say we are going to issue a debit note. And if the note that the supplier is going to send to us is what we call the credit note. the credit note. So that is it. Then we move to the cash book. We move to the on daily basis. So one thing that you have to know, the cash book is a journal and also it is a ledger. You have to know that. This is because when it comes to the journal part, the cash book is a book of prime entry in that all cash and are first recorded. Cash and check are first recorded. It is when a transaction occurs and it involves cash and check. It is the cash book that is first recorded. That is why we say it is a journal. And why do we say it's also a ledger? We say it is a ledger or it is an account because it has a debit and a credit side. So when you look at the format on for the purchases journal and the sales journal and the sales region, I'll be I'll be solving questions on purchases journal and sales journal. So subscribe to the channel. So when I upload these tutorials, an app, you have a notification. So the cash book has a debit side and a credit side, and it is the cash book. The cash book is a book of prime entry, in that all cash and all transactions involving cash and check is first recorded, and at the same time, it has a debit and credit side. That is why we say it is a journal and it's also a ledger account. But then when you look at this purchases journal and the sales journal, it has no debit and credit side. So it is just a journal. But when it comes to the cash book, it is both a journal and a ledger account. Let's note this. So the cash book, there are types of cash book. One, we have the single column cash book. We have the single column cash book. And two, we have the two column cash book. So with a single column cash book, normal T account. It's just the normal T account. So the single column cash book is just like this one. Then so just the cash account. Then we have the credit side. Then we have the debit side. Then when it comes to the two column cash book, the two column cash book is where we have the cash and bank. We have the cash column and we have the bank column. We have the cash column, then we have the bank column. So that one too is something like this, where we have the dates here, then we have the particulars here. Then we can have here, then we have bank here. So that would be for the debit side. Then you do save on the credit side. So the two column is the cash and the bank. That is the two column cash book. Then the three column cash book is where there is discount introduced. So that one too, we have the date, then we have the particulars, then you can have your cash, then you can have your bank, then you can have your discount. Then you do same for the credit side, dates, particulars. So we have the debit side and we have the credit side. So the three column is the cash, the bank, and the discount. So that is the three column cash book. I'll be posting some tutorials on it, so subscribe to the channel and click on the notification bell. Anytime a video is uploaded, you'll be notified. Then we have the petty cash book. So when we talk about the petty cash, it is used to record cash receipts and cash payments which are of routine nature using the copies of cash receipts and petty cash vouchers. So with a petty cash, it is used to record the petty expenses that occur in the business. So the business wouldn't want their petty expenses like buying office space, buying stationery, and all those things to be in their cash book. Business wouldn't want their petty expenses like purchasing of office pins, stationery, telephone expenses, postage expenses, those petty expenses. The business wouldn't want those petty expenses to be being in their cash book, where their cash book is used to record huge sum of money. Do you get it? So they set aside this petty cash book to do those payments of um, petty expenses of routine nature. So let's say every week they are going to purchase office pins. They can't be recording those petty expenses in their cash book every week. So what they do is they get a petty cash book and they will use the petty cash book to do those payments of petty expenses. Yes, so that is what the petty cash book is used for. And the petty cash book is is operated in the imprest system. So when we talk about the imprest system is a system of keeping records in the cash in the petty cash book. So the imprest system is a system where an initial amount, yeah, so that is where the initial amount is given to the petty cashier, and that amount is called the cash float. That amount that is given to the petty cashier, let's say that amount is from the main cashier or the accountant to the petty cashier. So that amount that is given to the petty cashier is what we call the cash float. So that amount given to the petty cashier is used for those small and non-reoccurring expenses of the business. That is the imprest system. So let me put it in imprest is when you talk about the imprest system, it's a system where an initial amount called the cash float is given to the petty cashier to be used for small and non-recurring expenses of the business. That is all about the petty cash book. And we come to the general journal. So now we are done with the special journals. So the general journal is used to record transactions that cannot be recorded in the that cannot be recorded in the other journals. So any transaction that cannot be recorded in any of the other journals, it is the general journal that we use to record. Yes, it's the general journal that we use to record. So, what are some of the uses of the general journal? It is used for correcting errors. So, when we are correcting errors, it is the general journal that we use to record errors. And also, it is used for writing off bad debt. It is used for recording opening and closing entries. When there is a purchase or sale of fixed assets on credit. So when there is a sale or purchase of fixed asset on credit, we don't record it in the purchases journal or sale journal, but then we record it in the general journal. But then when there is a purchase of goods on credit, then that will go to the purchases journal. But when it is a fixed asset, then we use the general journal to record it. And also when the company issues its shares, it is the general journal that we use to record. So let me talk about discounts, trade discounts, and cash discounts. I'm talking about this because of the purchases journal and sales journal. There can be discounts, and also the cash book where there will be discounts too. So when we talk about trade discount is where you have a reduction in amounts of the goods that you are paying in order for you to purchase in bulk. So if you are purchasing from someone and the person wants you to purchase in bulk, what we call the trade discount. Then we come to the cash discount. The cash discount is where there's a reduction in the amount that you are supposed to pay to to help you pay the amount promptly. Do you get it? So there can be that the person will say, if you are able to pay the amount in 1 week's time, then pay this. So let's assume you are supposed to pay 1,000 Ghana cedis. It is saying that if you are able to pay within 1 week, then pay 900 cedis. But then if you can't pay within 1 week, then I'm still going to take my 1,000 cedis. So that 100 cedis reduction is what we call the cash discounts. So this discount enables or encourage prompt payment of money. So that is all. So that is all for today. You'll end here. Then don't forget to subscribe to Rad Accounting Tutorials and also click on the notification bell for more videos. Subscribe to the channel and you have more videos to watch to build your understanding in accounting. Bye bye. See you in my next video.